Hi, I'm Mal from the Money Study, bringing you another episode of our Take 10 Challenge, up to number 97, part 6 of our buying and investment property. This is all about all those other sort of costs in getting into our property in the first place. There's our disclaimer, facts and figures in today's session. There is no advice in this video. Okay, we've already talked about in the last session about finding money for our deposit and all the costs involved in that, and also that pretty heavy cost of our stamp duty. But along with that, there are also quite a few other little costs that unfortunately add up. And this is where people get caught out. They think, okay, I'm going to buy an investment property for 500, 600,000, but by the time they add all these other associated costs, they just don't have that money sort of lying around in those first few weeks or so at the time of the settlement of the property. And we're going to make sure we've got enough money to cover all these extra bills, and we're not going to get sort of caught out. Of course, it's a legal transaction in purchasing our property. So normally we're going to have either a solicitor or conveyancer, and I'll talk about that in a bit more detail in another session. But you're going to have to cover the costs of getting someone to do it. And look, I would strongly suggest that you can do your own conveyancing, but I must admit I would strongly suggest you get someone who knows what they're talking about. I know from a personal situation, my daughter saved a hell of a lot of money by using a very good conveyancer who picked up some issues in a property she was looking at a few years ago. So it just means that they can go through all the legalities of the transaction to make sure there's no sort of little hidden surprises that we don't want to get caught out with somewhere down the track. Getting a good pest and building report done means that we're not going to find out they've just bought a property where it's riddled with things like termites or some other issue that is going to cause us great problems there. It'll just check for the structural soundness of the building as well, to make sure that there's no sort of major cracks or some sort of water going through the property that's causing us some dramas there. It's just going to give us a bit of peace of mind before we jump into it, because all these things indeed cost us money. And of course, depending on where your property is, that prices vary if we've got to get some person out to somewhere out the back of Whoop Whoop somewhere. You may have indeed used a buyer's agent to find the right property, and generally speaking, yeah, that's not it's a cost that could indeed actually save you money. If a buyer's agent has found you a good property and they can negotiate a good price for you, hopefully their fee you've made back in the fact that you've got yourself a good property at a good price. But it is in cost to incur there. But these buyer's agents are becoming far more popular in this, especially for investment properties, because they know what to look for in an investment property. Sometimes people sort of looking for an investment property are looking at a property they would like rather than really looking at it in the eyes of an investor. And so a buyer's agent can be a little bit stand back from it and say, yep, what we're looking for, good yield, good place, close to amenities and so forth, and obviously got good potential for capital growth. But yep, there is a cost involved in utilising a buyer's agent. With your home loan, there are going to be fees. And if it's a more complicated sort of structure, you've got multiple loans and fixed rates and variable rates, offset accounts and so forth. The more complicated the loan, generally speaking, the loan fees will be going up there as well. Look, have a chat to your bank about this. If you're borrowing a big chunk of money, they want your business. So it's not something you can just have to wear. Quite often you can negotiate with them to avoid some of these fees or get at least one or two of the fees waived. A good mortgage broker would assist you in this regard to have a waiver perhaps or negotiate those fees for you. Your actual mortgage is a registration fee that again varies from state to state, but it's a fee it's charged on registering your home loan, where your property is acting as the security. So it's just another way for the government to get their little snip out of this whole transaction. But it really is just another fee. But to say, you've got to make sure that you've got this money put aside to pay for it. Now, of course, if you've bought a property and you think, well, yep, I'm going to rent it out, but those carpets are not looking that good. It's looking a bit, dowdy. The paint's a bit dirty. Then perhaps we're going to have to look at spending a bit of money up front just to spruce this place up. Now, generally speaking, most people spruce it up to sell it, but not always the case. It could be the sale of a property from a deceased estate or something like that. Someone had to sell it in a hurry, whatever the case may be. But if you find yourself in the situation where you do indeed have to spend some money on it before you rent it out, it may have been a case of being fine for someone to live in, but for rental, it may be some other changes that may need to be made. Just realise that any improvement that you do here, because you haven't even received rent up front, this is a capital improvement. You're improving the value of the property before you even rent it out. It's not a repair. And so you're not going to be able to claim that. You're not going to be able to claim that as an expense in that year. Except for the ACT, which we'll talk about the ACT in a separate session. But effectively, this is an improvement on what you have purchased. It's a capital improvement, meaning that you're only going to be able to get that as a tax deduction back when you come to sell the property 10, 15, 20 years down the track. So it'll be offsetting your capital gains tax. Because it's not a repair, it's an improvement, totally different way that the tax deductions are applied. And we'll talk about this in an upcoming session. But people think, at least I'll get a tax deduction. Well, you're not going to get a tax deduction in the year that you're actually doing the work, generally speaking. Getting a quantity surveyor might be a damn good idea. Now, basically what it comes down to is that with an investment property, we can indeed claim depreciation. And so we're going to claim depreciation on some of the fixed contents of your house. And as they go down in value, obviously they're going to need to be replaced at some point in time. But as they go down, this depreciation, we can claim it as a tax deduction. And this is one of the really effective things of having an investment property, because it's not an expense you're actually incurring. I mean, it is going down in value, and yes, you're going to have to do it and replace it at some point in the future. But depreciation is just this thing saying, okay, that's gone down in value, yes, therefore we can actually claim it as a tax deduction. But to be able to really claim depreciation accurately, we need someone to go through it, drawing up a depreciation schedule. So a quantity surveyor comes in before as soon as you've bought the property, go through looking at all these fixed components of your property to saying, okay, this is the value of each of these things right now. And therefore, when you come to talk to your accountant's got a value of these things that they can then create this depreciation schedule. So having it drawn up is going to make it a lot more accurate, and the ATO is certainly going to appreciate it more than you just coming up guessing numbers. So, yep, having that extra cost, yep, again, it's a cost, it's a tax deduction, but it is a case of being a bit more accurate is going to help us along the track there. Insurances, then yes, most lenders will make sure that you do have this building insured even before they lend you the money. So they don't want to find a situation where you've just taken on a loan, but unfortunately the house burns down, as soon as it's settlement, and you haven't got any insurances. So they'll make sure that you've got the property insured. And of course, if it's an apartment or a unit, the insurance could indeed be covered in the strata costs. meaning you pay a body corporate, which is the people who look after all the running expenses of a whole apartment block or set of units. And the insurance could be across the whole building, and you pay the body corporate a portion of it. But if you've got just a freestanding building like a normal home, then yes, you're going to need to get your own insurances. But either way, your lender is going to make sure there's some sort of insurance in place. Now, of course, it could be a case that you might want to also take out landlord insurance. Now, landlord insurance is going to protect you from problems with the tenant. So they might, walk out and damage the place. They might not like you because you've tried to put up the rent, and as they leave, they punch holes in the wall, or they'll just downright dirty people, and the whole place really needs a good spruce up after they've gone, and so forth. All of these things problems caused by a tenant or from natural causes can be indeed they're covered by the landlord insurance. So another expense. And generally speaking, with any of these insurances, of course, you've got to set them up. You're paying your premium immediately. Instantly you take it off. So this is a cost you've been hit with day one. Even though, yes, you'll have ongoing insurances, but the people don't realise that you've got to find these insurance money straight away. Day one, the day you start your investment property. Yep, and of course, we've got council rates. So be it if we've got a house on a block of land, or we've even got a unit, there's generally speaking some sort of a council rate that's going to apply. It's usually based on the land value, and of course this is going to vary from council to council. If you've got an apartment, then the rates may be included as part of the strata fees, but of course if you buy a house, then you could be up for that prorated amount of the council rates for that particular quarter. Now, we talk about these strata fees. A strata fee is effectively, if you've got an apartment or a townhouse or something similar, then you pay a fee or a levy which covers the upkeep of all the common areas, things like, it might be the lobby, the lifts, your gym, your swimming pool, and garden areas, fencing, you name it, all the bits that are common to all the various different apartments in that whole complex. And so you've got a strata fee. Generally speaking, a lot of people just call it a body corporate fee. Whatever it's called, effectively you're up for this fee, which is usually payable quarterly. And of course, if you buy a property, you've got to pay the upfront. You've got to pay the prorated amount from the time that you've purchased it to the end of that quarter. So again, another fee we've got to find upfront to pay it. It'll be an ongoing cost, but we've also got an upfront cost to pay for that prorated amount. Similarly, we've got our things like our utility bills, so our electricity and water and so forth. Now, generally speaking, they're going to be covered by the tenant, but as a landlord, you may need to set them up in the first place, in which case, you might have a set-up costs in getting those things up and running in the first place. So they may not be huge, or starter fees might be, or I suppose your council rates could be as well. But these are extra fees, extra charges, more costs involved in buying our property in the first place. So happy to discuss how all these things work, and look forward to you joining me in the next session.